Have you ever felt frustrated entering a trade and getting stopped out right before the price moves exactly as you expected? This happens because many traders don't know where the market's liquidity is. Today, I'm going to show you a simple and powerful strategy based on liquidity sweeps, which are the market's liquidity sweeps. It pinpoints exactly where the big players are, taking out the small traders' stops before moving the price strongly in one direction or the other. And the best part is, we're going to use 2 free indicators here on TradingView. And if you want to trade with more precision and less anxiety, stick with me and watch until the end. First of all, we're going to be here inside the TradingView platform. I'm going to use the Euro to US dollar chart, but you can trade on any pair, on the 1-hour time frame as well, but it could be on any time frame from 15 minutes upwards. The first indicator we're going to use, we go to the Indicators tab and look for liquidity sweeps. It's this first one here, developed by LuxAlgo. Let's click on it, and as soon as we do, it appears here on our chart. The other indicator we're going to use, we go again to the Indicators tab and type in 7 EMA, just like I wrote now. It's this first one here from Storewise. A tangle of moving averages will show up. You'll click on them and make the following settings. The first average to 8, the second average to 13, the third average set the period to 21, and the fourth average, period 34. And now you go to Style and uncheck everything from the 5th one onward. Uncheck all the boxes, leaving only the first 4 that we added to the chart. Now your chart is exactly how it should be, with the moving averages of 8, 13, 21, and 34, which we'll use together with the liquidity sweeps indicator. First, let's understand how the liquidity sweeps indicator works. It shows areas where the market seeks hidden liquidity, that is, places with a high concentration of stop orders. Thin lines represent liquidity zones. Red lines indicate the buy side, above the highs, where there are sell stops. Teal means the sell side, below the lows, where there are buy stops. The colored rectangles that also appear on the chart mark the moments when this liquidity is swept. The red rectangle indicates a sweep of buy-side liquidity. The green rectangle means the sweep was on sell-side liquidity. These events are usually followed by strong moves in the opposite direction, and that's where our opportunities arise. Notice right here at this exact point where the market swept liquidity. It made this very long wick, reached for the liquidity down here, and even left the rectangle marking the liquidity sweep. And see how the price went there, grabbed it, rejected the area, and then just shot up. So, how could we use this indicator to enter a long position? Basically, we would wait for the candle that swept the liquidity to close, and then we'd place a buy order at the close of that liquidity sweep at the bottom. If it swept the liquidity down here, that means it now tends to go after new highs. So, we could set our stop just below the region. Here, that would be about a 0.3% stop, and aim for a take profit at least twice that to the upside, meaning 0.60. Let's see where the chart ended up hitting, and it was roughly at this candle here, so our take profit was reached shortly after. And for the sell side, it's basically the same thing, just the other way around. When the market sweeps liquidity on the upside, like it did here showing a sell block in the liquidity sweeps, we wait for the candle that swept the liquidity to close, open a sell position on it, set our stop a little above the region, in this case at 0.25%, and we can set our take profit at twice that to the downside, so at 0.50 in this case, which was hit right in the middle of this candle. That's another winning trade using liquidity sweeps. But remember that we added the second moving averages indicator, which is exactly the indicator that's about to appear on the screen now. So, to take trades with greater confidence that the trade is likely to develop either upward or downward, we'll use the moving averages to understand if the trend is strong at the entry point. Like, for example, in this case right here. Notice that all the moving averages are aligned upward, without touching each other. Here they were very close, but they weren't touching these first two. In this case, we can see that when the market does a liquidity sweep in the liquidity sweep region, it's signaling a buy, with all the moving averages separated and pointing upward. So in this case, we have a stronger buy signal. Why is that? Because the market is retesting a region and is going after new targets within the trend that was already in place. And in this case, look at how the market shot upward after that. Shall we look at a downtrend now? Notice exactly at this point where it's marked with this red line. The market swept this liquidity, formed the region in a liquidity sweep to a slightly weaker zone, but it did, in fact, reject this point. We could have entered right here at the candle close, aiming for a downtrend. Why is that? Because the moving average indicator had all the averages separated and pointing downward, meaning the market tends to fall from here, continuing the downtrend that started back there. This strategy combines the power of hidden volume in the market with the direction of the trend, a combo that many professionals use. By trading only in the direction of the trend after a liquidity sweep, you cut out the noise and improve your chances of success. Start by testing this approach on a demo account and watch how it performs. If you enjoyed this content and feel it brought you value, don't forget to subscribe to the channel to get more videos about indicators like this one. Also, like and share it with your friends. And remember, this content is for educational and informational purposes only. It is not a recommendation to buy or sell assets. Always do your own analysis or consult professionals before investing.